Good morning, everybody. Happy Thursday, everybody. Today is Thursday, June 15th, 2023, and we got a whole slew of economic data released this morning, and virtually all of it is pointing to the same thing: deflation, or at least deflationary forces. Now, before we get into the data, a lot of people are jumping down my throat every time I say deflation these days. Guys, understand the terminology and understand what the data says. First of all, inflation, deflation, we're talking about a rate of change. All right, when I say lower inflation, I'm not talking about prices going down. When I say lower inflation, I'm talking about prices going up, but prices going up slower. When I talk about something being deflationary or disinflationary, that's something that is putting downward pressure on prices. Again, doesn't necessarily mean prices going down. It just means there is downward pressure being put on prices by that information. And finally, if I talk about outright deflation, deflation means prices going down. Now, the economic textbook definition of deflation would be a reduction in the money supply. We are seeing that. But for most people out there watching, who, all the people I can feel the eyes rolling in the internet right now, you're not seeing prices go down in your daily life yet, okay? And most people actually still feel like inflation is getting worse because the effects of the inflation that we felt last year are cumulative, right? When your rent went up $500 a month last year, you're having to eat that extra $500 every single month over and over again. So it still feels like it's going up every time you pay that rent. But the price is not rising anymore on the national average, or at the very least, it's rising very slow, much slower than last year. Well, we got data this morning. Import and export prices down. Jobless claims up. Retail sales up, but up just barely, up below the rate of inflation. We also got manufacturing indexes from New York and Philadelphia pointing to declines in manufacturing. And we're getting data out of China that shows that China reopening is a dud. All pointing to the same thing: a deflationary global recession is on the horizon. Elsewhere today, we got a 25 basis point rate hike from the European Central Bank this morning. This is just after Jerome Powell announced the much anticipated Fed skip, or the Fed pause, whatever you want to call it, yesterday. So we're seeing the U.S. dollar weaken a little bit against the euro today because, well, they're hiking in Europe while we're pausing in the States. So that would weaken the dollar versus the euro, much like last year when the U.S. started hiking first and the European Central Bank was slower to hike. The dollar started to rally first, and then the euro would eventually play catch up. All right, and with that, I have to say thank you very much to the sponsor of today's live stream, Patriot Gold Group. Guys, we're going to talk a lot about central banks and the effects of central banks. Forget for 1 second what the central banks are telling you. They're always going to tell you how strong the economy is and how they have everything under control. And let's not forget all about transitory. Now they're telling us, don't worry, we're going to stick this soft landing. Like, no, yeah, right. If soft landings have literally never happened before. But you know what central banks all over the world are doing right now? Central banks around the world are buying gold. In particular, central banks in the East are buying gold. So you can swallow their talking points at face value and believe everything they say, or you can look at what they are doing and position yourself accordingly. And that's why I am happy to endorse the Patriot Gold Group. So go to nsfgold.com or call 888-988-5401. Ask about their gold and silver-backed IRAs, their no-fee-for-life IRA. And, of course, don't forget to tell them that nobody sent you. And with that, we are going to shrink my big melon of a head, and let's see what's going on in markets this morning. The S&P down 10 points, or 0.23% at 43.62 after shrugging off yesterday's Federal Reserve press conference. We've got the Dow is up 14 points, essentially flat for the day at 33,993, just below that all-important 34,000 level. And the NASDAQ is down 55 points this morning, or 0.4% at 13,571. So we got a mixed bag in stocks this morning. The U.S. dollar is back under 103 right now at 102.71, down 24 basis points this morning. And these big green or red candles down here, that was the ECB announcement of the rate hike. So we are seeing a weakening of the dollar against the euro right now, and the euro is the biggest input to the DXY calculation. So I'm not terribly surprised to see the DXY lower this morning. Looking over at the bond market, we have got yields lower this morning. That means bond prices are higher. People are buying bonds in the AM. The 10-year is yielding 3.74, down 5 basis points. The 2-year yielding 4.64, also down 5 basis points. And yields virtually across the board are lower. Over in the commodity space, we've got gold is down $14 this morning, 1,954, or down 0.72%. Silver is down about 38 cents at 23.72, down 1.6%. Crude oil catching a little bit of a bid, up 80 cents this morning, or 1.19%. Still below the all-important $70 level, 69.08 in oil. And again, speaking of deflationary forces, guys, I've talked about it virtually every day since it happened. OPEC cut production by 1 million barrels per day last week, and prices just don't care. Prices have gone down since that production cut. Deflationary. Elsewhere, natural gas is at $2.42 this morning. Couple of stories building up in natural gas right now. We've got the announcement from the Netherlands that they're shutting down the Groningen gas field. That's one of the biggest gas fields in Europe. That one's shutting down. We're seeing some stories about China pausing some LNG orders after a spike in LNG prices. So keep an eye on the natural gas trade for now. I'm not sure what's developing over there, but there's a lot of complacency in natural gas markets because prices over the winter, we never got the cold winter that we were worried about, and so prices have been down in the doldrums. Watch some of these stories in the natural gas market. All right, folks, let's talk about some of this economic data here. First things first, retail sales in the United States year over year. This one just hit the tape this morning. Retail sales in the U.S. increased just 1.6% year over year in May, following a downwardly revised 1.2% rise in April. Now, retail sales are up 1.6%. Maybe, Jack, hey, that's inflation. Well, remember, these numbers are not adjusted for inflation. So if you take the government's CPI data point at face value of 4%, retail sales are only up 1.6%. That means there's a net decline of about 2.4% in the amount of stuff that is leaving the store. People are buying less. That's deflationary, folks. And you know, the saying goes, the solution to higher prices is higher prices. And we're seeing this in retail sales. After last year's inflation, which was so miserable, people are spending almost all of their income on their basic needs, things like rent, utilities, food. There's just nothing left at the end of the month to go buy this other stuff, and so there's less stuff selling. Now, sooner or later, that's going to translate into lower prices as the people who sell that stuff start competing for your dollars, which are fewer in number, so they'll lower their prices. Right now, at just 1.6% increase, well below the rate of inflation. Elsewhere, import prices year over year in the United States are down 5.9%. After being down 4.8% in April. Guys, this is actual deflation here. Prices down. Now, you're not seeing this in the store yet. This is what we're paying to import the stuff, to bring the stuff over from China. But look at this. All year, this has been going down. It was at its high last year in June. Remember, we were getting those 9% CPI numbers. So, of course, prices were spiking last year. But the increase in prices started to gradually slow starting last summer, slowed all through the winter, dipped into negative territory at the beginning of this year, and now here we are deeper into negative territory, down 5.9% year over year. Deflation. Oh, this is import prices. Let's look at export prices. Wow, even worse. Let me refresh this. Export prices in the U.S. dropped 10.1% year over year in May of 2023, following a revised 6% decrease in April. It was the largest 12-month decline since the series was first published in 1984. So this is export prices. Again, same story. They were spiking last year at the height of the inflation. They started to come down when the increase in prices is coming down. Again, that is inflation, but it is lower inflation. The increase in prices came all the way down to zero and went negative. Now we're deeply negative. Deflation. 10.1% year over year decline in export prices. Again, folks, this is a very deflationary data point. Philly Fed Manufacturing Index. This is an index, anything below zero represents manufacturing activity contracting. Anything above zero represents an expansion and manufacturing activity. Now, this is for the Philadelphia Federal Reserve Bank region. The Philly Fed Manufacturing Index in the U.S. decreased to negative 13.7 in June from negative 10.4 in May, and that compares with expectations of minus 14. Now, look at this. The Philly Fed Manufacturing Index, this has been in negative territory for what? 11 out of the last 12 months. Manufacturing activity in the United States is declining. Less economic activity. That's very recessionary. Again, this is showing a deflationary recession is on its way, if not already here, as shown in manufacturing. And I just want to mention, guys, these are month over month changes in the index. Now, these aren't percentages. This is an index. But every time you see two consecutive yellow bars here, that's a decline from a previous decline. So this is a cumulative area under the curve kind of chart here. Manufacturing activity in the Philly Fed area is in steep decline right now, and it's been that way for almost a year. Now, the Empire State Manufacturing Index in New York is the one silver lining in this big gray cloud of deflationary data points. I have to include it because I got to keep myself honest. The Empire State Manufacturing Index is at 6.6 this month. So this is showing an expansion over the last month. So this does somewhat contradict my thesis here, but I have to put this out here. I got to be honest. I'm going to present the data that doesn't suit my narrative along with the data that does suit my narrative. But let's talk about this for a second. 6.6. All right, it's technically an expansion, but look at how big the declines have been over the last few months. All right, so it was a slight expansion from a massive decrease seen last month. That's hardly a reversal in a trend. This looks more to me like a dead cat bounce than anything else. And again, if you take the aggregate of this chart, over the last year, we've seen a substantial slowdown in manufacturing activity in the Empire State. So again, very deflationary data point. And the last one I got to talk about is initial jobless claims in the United States. People filing for unemployment benefits were at 262,000 for the week ending June 10th. And let me refresh this one here. So it shows the bar chart. There you go. 2 consecutive weeks of 262,000 initial jobless claims. Those layoffs from earlier in the year, remember all the tech layoffs that were announced in January, February, March, they're starting to result in people filing for unemployment benefits. A spike in unemployment, that's another thing that's indicative of a deflationary recession. 2 consecutive weeks in a row now with elevated initial jobless claims. And if you look at a one-year chart of that, you can see we ticked up and we are staying up now. Again, this is a deflationary data point. But it's not just in the U.S., guys. We're also seeing it in China. This one just this morning, China's economy is way more screwed than anyone thought. It's kind of a strongly worded headline here. I'm going to scroll all the way down in this article to this paragraph here. The problem is while consumers may be picking up, the biggest drivers of the Chinese economy, property and exports, are going to stay dormant. Consumer consumption makes up about 37% of the Chinese economy. In the U.S., that figure is about 70%. So a return to normal activity from consumers is helpful, but it's not enough to carry the economy. China was never going to be able to deliver on the miracle reopening that Wall Street wanted without getting the wheels of its massive exports and property machines moving. Exports and property, that's what's driving China. Well, exports are way down in China, and property is the biggest bubble of all time that's in the process of bursting. Beijing has tried to shift the country toward a consumption model like the U.S., but exports still make up 20% of China's economy. In May, outbound shipments declined 7.5%, the first decrease this year. There you go, deflationary data point, 7.5% decline in exports. We see that in the U.S. import prices coming down. That matches the decline in Chinese exports. The slump is largely due to a general global economic slowdown, global deflationary recession, but it's also due in part to unfavorable geopolitical dynamics that seem to worsen by the day. Imports, an important indicator of China's domestic health, also slowed. Beijing put the entire economy in a deep freeze during COVID, but that doesn't mean reopening will heat things up. China's economic return will be lukewarm at best. And there's more deflationary data coming out of China. This one this morning from Bloomberg, China's weakening economy puts a focus on stimulus after a rate cut. We just got done with a Fed pause here in the States. Well, China is cutting rates. they're trying to put stimmies out there over in China right now. That's not something you do when you have a big inflation problem. PBoC cuts their one-year policy rate after lowering short-term rates, and private business investment contracts as property weakens. Just want to give you a couple of these data points. PBoC cut the rate on its one-year loans or medium-term lending facility by 10 basis points to 2.65%. So it wasn't a huge cut, but it was a cut. Growth in industrial output slowed to 3.5% from 5.6% in April. So now we're getting into disinflationary here. We're still talking about growing, but we're growing slower. Retail sales grew 12.7%, below expectations. Again, that's disinflationary, with sales of the property market and related items such as construction materials and home appliances are easing. Fixed asset investment in the first 5 months of the year rose 4% from a year earlier. Investment by private businesses contracted 0.1%, while property investment declined 7.2%. So this China reopening, the jumpstart in Chinese growth, not happening, folks. It's not happening. The growth numbers in China, and understand, guys, we're coming out of decades of double-digit growth in Chinese economic activity, right? They called it the China economic miracle. It's over. It was fake. It was a property bubble. And now, even with the PBoC cutting rates, even with the stimulus package that China announced back in November, their 16-point plan to rejuvenate their property market, they're only getting low single-digit growth. And again, these are Chinese Communist Party statistics, so you have to wonder, are they even really getting that? One last thing I'm going to add, China's youth unemployment hits a fresh record high. Major data disappoints. Youth unemployment for people 16 to 24 in China is 20.8% in May. That is a record high after the recent record was set in April. Now it's even higher than that. So, guys, we're not just seeing deflationary stuff here in the States. We're also seeing it overseas in China. We're seeing it in the Chinese export market. And China exports to pretty much everyone on the planet. So I know it's hard for a lot of people to swallow the deflation narrative, especially after suffering through inflation all last year. And we continue to suffer from the inflation felt last year. But there are so many disinflationary forces and deflationary forces at work right now. We're going to start seeing it in asset prices. There's less money circulating. There's tightening credit conditions. Money's becoming harder to come by. And when money gets harder to come by, people start competing for money, which means prices start going down. It's not going to translate into lower prices at the food store anytime soon, but it will eventually. That is, unless the Federal Reserve just goes burr and turns the money printers back on, which, of course, they're sure to do at some point in time, but not until the pain gets worse. I've been saying for a while that the Fed will eventually turn the money printers back on. Why? Because we beg them to. We're not yet begging them to do that. And I just want to say thank you very much to Mr. Steve Woitis, who says, with home and personal credit lines at 7 to 10%, has the consumer stopped discretionary spending and just focusing on paying down debt? No, Steve, the consumer has not started focusing on just paying down debt, although that's not a terrible idea as interest rates are increasing. Let me just show you this one real quick. Consumer credit in the United States for all commercial banks. And as much as I wish people would get out of credit card debt, and as many times as I've told them you've got to get out of credit card debt, this is America's credit card bill, and it is just rising month after month after month. And I think this is one reason why people are having such a hard time getting their heads around this deflationary talking point, because people are still suffering from the inflation of last year. Those price increases that have already happened are still inflicting pain on the average person, and the average person is having to go into debt to pay for that. So when you tell that person, hey, there's deflation coming, they're going to react angrily, because it almost makes it seem like you're trying to marginalize what they're going through, their economic hardship. That's not what I'm trying to do here. I'm not trying to say it's your imagination that this high credit card bill and your personal situation is in your head. That's not what I'm telling you. I'm saying the prices are not going up anymore, or the ones that are going up, they're going up a lot slower. And in some sections of the economy, they finally started to come down. But that doesn't mean people aren't still racking up the debt to pay for price increases that have already happened. Remember, inflation is a rate of change. All right. It already changed last year. It's not coming down, but it stopped going up. people are still going into debt to pay for that. Currently, $991 billion worth of credit card debt in the United States. And that's dangerous, guys. Oh, wait, what do I have the wrong. How come we're not seeing that chart? We're still showing the dollar index. I don't know what's going on there. Anyways, guys, long story short, no, deflation is not going away. Inflation is not going away anytime soon. I don't know what happened with my screen there, guys. I thought I was showing the credit card machine. Something froze up. But thank you, Steve Waitis. I appreciate the super chat and support of the channel, sir, very much. And again, folks, get out of credit card debt if you're not already. If you're in credit card debt, the average credit card interest rate is something like 22% now in the U.S. Guys, you're a slave. You're an indentured servant if you're in credit card debt. You're working for someone else's benefit, not your own. Don't lie to yourself. Don't convince yourself, I deserve this while you're at the store, and use that as an excuse to make that credit card balance even higher. You deserve to not be a slave. You deserve to not work for someone else's benefit. You deserve to be debt-free. So don't trick yourself into putting more money on the credit card. Now is the time to get out of debt. Those interest rates are going, well, they're already high. They could go higher. The Fed is telling us they're going to raise 2 more times this year. So what are you waiting for? Get out of credit card debt. Thanks again, Steve. I appreciate the super chat and the support of the channel. Thank you to my Patreon supporters for everything you guys do for the channel. I appreciate that very much. Link down below should you feel so inclined. There's also a link to nsfgold.com down below. Thank you to Patriot Gold for sponsoring this live stream. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.